Greetings and welcome to Corporate Finance. This is Dr. Moultrie, and in this video, we will discuss stock valuation, which is part of Chapter 7. So the chapter outline is as follows: stock basics, the mechanics of stock trades, the dividend discount model, estimating dividends in the dividend discount model, limitations of the dividend discount model, share repurchases and the total payout model, and putting it all together. The learning objectives are: understand the trade-off between dividends and growth in stock valuation, appreciate the limitations of valuing a stock based on expected dividends, value a stock as the present value of the company's total payout, describe the basics of common stock, preferred stock, and stock quotes, compare how trades are executed on the New York Stock Exchange and NASDAQ, and last but not least, value a stock at the present value of its expected future dividends. Here you see in figure 7.1, which shows the stock market reporting of Nike, okay? There's panel A and B, which display essential stock information sourced from Yahoo Finance concerning Nike's stock. Now, Nike's stock is categorized as common stock, entitling its holders to dividends and voting rights on significant corporate decisions like director elections and mergers. Now, being that Nike is a publicly traded corporation, its shares are widely held and traded on the New York Stock Exchange under the ticker symbol NKE. Now, the ticker symbols are unique abbreviations that are assigned to publicly traded companies for reporting trades on the ticker, which is an electronic display of real-time trading activity. Now, traditionally, the New York Stock Exchange ticker symbols consist of 3 or fewer characters, while NASDAQ ticker symbols, they typically have 4 or more characters. However, recent listings like Meta, which is Facebook, it is identified as FB on the NASDAQ. And Twitter, the symbol is TWTR. That is the abbreviation for the New York Stock Exchange. Here again, you'll see figure 7.1, which is the stock price quote for Nike. As I mentioned earlier, the ticker symbol is NKE for Nike. And you see that the real-time price for Nike at that particular time on July 5th was $102.79. And that was at the opening of the market, or market open. Okay. Now, let us explore into the entitlements of common stockholders, particularly their influence in corporate governance. Now, shareholders' rights correspond to the number of shares they possess, ensuring that each number or each shareholder's influence aligns with their shareholding. To demonstrate the shareholder voting process, now let's consider a hypothetical scenario with two shareholders. We have Donna and Jonathan, and they are participating in the election of 10 directors at a company. Donna holds 600 shares, while Jonathan, you see, holds 400 shares. So in a straight voting system, each share equates to one vote for each director, resulting in Donna having 600 votes and Jonathan having 400 votes per director. So therefore, with straight voting, Jonathan would not secure any director representation due to his lower number of shares. As an alternative, with cumulative voting, the total number of votes for all directors is determined by multiplying the number of open spots by the shareholders' number of shares. In this case, with 10 directors up for election, Jonathan would have a total of 4,000 votes, while Donna would have 6,000 votes. Now, with cumulative voting, shareholders like Jonathan could strategically allocate his votes across fewer directors to ensure representation despite having a minority stake. It is important to note that this example is grounded in the principle of one share, one vote. However, some companies feature multiple classes of common stock with varying voting rights. Now, this practice is common in family-run businesses or those where the founder retains significant influence. For example, Nike possesses Class A and Class B stock, with founder Phil Knight owning the majority of Class A shares, granting him significant voting power in electing directors. Now, with a company like Google, which is really called Alphabet Incorporated, it offers Class A, Class B, and Class C stock. Now, while Class A stock is publicly traded, Class B stock, held by Google's founders and managers, carries greater voting power, providing them with substantial control over corporate decisions. Meanwhile, Class C stock, created from Class A shares, holds no voting rights. Preferred stocks. What are preferred stocks? Well, preferred stocks, which you should know, are a class of ownership in a corporation that grants shareholders certain preferences over common stockholders. Unlike common shares, preferred stockholders typically have priority in receiving dividends and assets during liquidation. While directors have the discretion to withhold dividends for preferred shareholders, they cannot pay dividends to common stockholders until the promised dividend for preferred shares is fulfilled. For instance, Nike issues preferred shares with a fixed dividend of 10 cents per share annually, ensuring that preferred shareholders receive their dividend before any payments are made to common stockholders. Preferred stocks come in two primary variants: cumulative and non-cumulative. Now, in the case of cumulative preferred stock, any missed dividend payments are carried forward and they accumulate over time. Consequently, if the company fails to pay dividends to its cumulative preferred shareholders for multiple periods, it must settle all accumulated unpaid dividends before distributing dividends to common shareholders. So on the other hand, with non-cumulative preferred stock, missed dividends do not accumulate, and the company can prioritize current dividend payments to preferred shareholders before distributing dividends to common shareholders. It is worth noting that the majority of preferred stocks are of the cumulative type. Also, some preferred stock agreements grant preferred shareholders the authority to elect one or more directors to the company's board if the firm significantly falls behind on paying preferred dividends. Now, you might be pondering whether preferred stocks fall under the category of equity or debt. Well, economically, it resembles a perpetual bond due to its assured cash flow to holders and the repercussions if those payments are missed. However, unlike debt holders, preferred shareholders lack the authority to compel the firm into bankruptcy. They stand ahead of common shareholders for annual dividends, but behind regular bondholders, since interest payments take precedence over dividends. So in the event of bankruptcy, the settlement hierarchy remains consistent. Bondholders first, followed by preferred shareholders, and then common shareholders. So unless the firm defaults on its preferred dividend obligations, preferred shareholders do not possess the ownership rights, typically of equity, such as voting on directors or crucial decisions. Now, despite these debt-like features, preferred shares are legally and taxably considered equity. Preferred shares are legally and taxably considered equity. Okay, we have a concept check here. What is a share of stock and what are dividends? Well, we know that a share of stock represents ownership in a corporation, entitling the holder to a portion of the company's assets and earnings. So when an individual buys shares of stock, they become a shareholder, whereas they own a fraction of the company proportional to the number of shares they hold. Shareholders typically have the right to vote. They have the right to vote on certain corporate matters, such as the election of board of directors. Dividends, on the other hand, are payments made by a corporation to its shareholders as a distribution of profits. Now, these dividend payments are usually made in cash, although dividends can also be issued as additional shares of stock or other property. Dividends are often paid on a regular basis, such as quarterly or annually, and they are typically determined by the company's board of directors. Now, dividends represent a return on investment for shareholders and are one of the primary ways that investors receive income from their stock holdings. Number 2, what are some key differences between preferred and common stock? We know that preferred stock takes precedence over common stock when it comes to receiving dividends and during liquidation processes, while common stocks usually grants voting rights for decisions like electing the board of directors. Preferred stock generally does not offer such privileges. Okay, we have another concept check. You own 20% of the stock of a company that has 10 directors on its board. Question number 1, how much representation can you get on the board if the company has cumulative voting? How much representation can you get on the board if the company has cumulative voting? With cumulative voting, you are able to get proportional representation by putting all of your votes toward 2 directors, allowing you to elect representatives to 2 seats. That's 20% of 10 seats on the board. In other words, with cumulative voting, you can pool all your votes and cast them for a single candidate or spread them across multiple candidates. Number 2, how much representation can you ensure if the company has straight voting? Straight voting. With non-cumulative voting, you vote on each director individually, and without a majority of the shares, you cannot ensure that your representative will win any of the elections. You could lose 80% to 20% in each of the 10 individual elections. Okay, so now we're going into the mechanics of stock trades, where we will discuss market order, limit order, round lot, super display book system, floor broker, and what is a dealer? Okay. So suppose you decide to invest in Nike and you place a market order to buy 100 shares of its stock. A market order means that you don't specify a price, but want the order executed immediately at the best available price. What happened next? In market terms, 100 shares constitute a round lot and are considered a small order. Such orders are typically transmitted electronically to the New York Stock Exchange via the Universal Trading Platform. Now, since it is a market order, priority is given to executing it against the lowest existing sell order on the limit order book. The trade would execute automatically in milliseconds. For larger or complex trades involving people, the process changes. At the New York Stock Exchange, the trade would still be transmitted electronically, but sent to the wireless handheld terminal of the floor broker. Now, the floor broker, holding a trading license, works to get the best execution possible for their investors. They may negotiate with selling brokers to buy your shares at the lowest possible price. Now, execution may occur electronically, or it could involve interaction between floor brokers, depending on the order, size, and the market conditions. If buying on an electronic exchange like NASDAQ, the process is slightly different. Orders are transmitted to the NASDAQ Market Center, where they execute against the best ask quote for the stock. For larger trades, you might split the order into smaller trades or use a dark pool, depending on the limit order book's depth. Now, selling shares follows a similar process, and you can even sell shares you don't own through a short sale. So, to decide whether to buy or sell a stock, you must estimate its value and compare it to the current market price. In the subsequent chapter, we discuss one traditional approach to valuing a stock, which is the dividend discount model. The dividend discount model, one-year investor. The valuation principle, it dictates that assessing the worth of any security hinges on evaluating the anticipated cash flows it offers to investors. To dive into stock valuation, we must scrutinize the cash flows for investors with a one-year investment horizon, exploring the relationship between the stock's price and the investor's return. Next, we shift focus to investors with longer investment horizons. Ultimately, our aim is to introduce the inaugural stock valuation method, which is the dividend discount model. Owning a stock can yield cash flows through two channels. The firm may distribute cash to the shareholders as dividends. Investors may generate cash by selling the shares in the future. the cumulative cash received from dividends and stock sales hinges on the investor's investment horizon. So we're going to initially explore the viewpoint of a one-year investor. When an investor purchases a stock, they acquire it at the prevailing market price per share, which is denoted as the PO that you see here. Okay? While holding the stock, they anticipate receiving dividends, which is represented by the DIV1 here. They're hoping to receive dividends throughout the year. So at the year's end, they plan to sell the share at an expected market price, which is denoted with the P1. So simplifying matters by assuming that all dividends are disbursed at the year's end. This is the formula that we would use. And here you see, you saw in 7.2, I believe, it represented the stock's dividend yield, which was calculated by dividing the anticipated annual dividend by its current price. Now, this yield denotes the percentage return expected from the dividends paid by the stock. On the other hand, the second term reflects the capital gain, which is determined by the discrepancy between the projected sale price and the initial purchase price. So by dividing the capital gain by the current stock price will give you the capital gain rate, expressed as a percentage return. Combining the dividend yield and the capital gain rate yields the total return of the stock, representing the anticipated return for a one-year investment. And here you see this equation 7.2. It asserts that the stock's total return should align with the equity cost of capital, implying that the expected return from the stock matches that of other investments in the market with similar risk profiles. Here I brought up the 7.2 equation over so you can still see it. Again, you see that the 7.2 asserts that the total return of the stock should be equivalent to the cost of equity capital. Now, this means that the anticipated overall return from the stock should match the expected return of comparable investments in the market with similar levels of risk. Here you see a multi-year investor. Suppose we plan to hold the stock for 2 years. Then we would receive dividends in both year 1 and year 2 before selling the stock, as shown in the following timeline. Here, still with a multi-year investor, the formula for the stock price for a 2-year investor is the same as that for a sequence of 2 1-year investment. And here on this screen, you'll see that the price of the stock is equal to the present value of all of the expected future dividends it will pay, along with the cash flow from the sale in year end. Alternatively, rather than having a stopping point where we sell the shares, we can rewrite the equation to show that the dividends go on into the future. And there's a formula that you see. Here we have a problem, example 7.1, stock prices and returns. Suppose you expect Long's drugstores to pay an annual dividend of 56 cents per share in the coming year and to trade for $45.50 per share at the end of the year. If investments with equivalent risk to Long stock have an expected return of 6.80%, what is the most you would pay today for Long stock? What dividend yield and capital gain rate would you expect at this price? So the solution plan, we can use equation 7.1 to solve for the beginning price we would pay now, the PO, given our expectations about dividends. Dividends is equal to 56 cents, and the future price, $45.50. And the return is equal to 0, of course, with a percentage, 0.068. We can then use 7.2 to calculate the dividend yield and the capital gain rate. So to execute using equation 7.1, we have this formula here. And when you put in the numbers, it equates to $43.13. And then using equation 7.2, we see that this price, Long's dividend yield, is 1.30%. The expected capital gain is $45.50 minus $43.13 equal $2.37 per share for a capital gain rate of 2.37 over 43.13 equal to 5.50%. To evaluate, at a price of $43.13, Long's expected total return is 1.30% plus 5.50% equals 6.80%, which is equal to its equity cost of capital, which is the return being paid by investments with equivalent risk to Long's. This amount is the most we would be willing to pay for Long's stock. If we paid more, our expected return would be less than 6.8%, and we would rather invest elsewhere. Here we have another problem. Example 7.1a, stock prices and returns. Suppose you expect Koch Industries to pay an annual dividend of $2.31 per share in the coming year and to trade $82.75 per share at the end of the year. If investments with equivalent risk to Koch stock have an expected return of 8.9%, what is the most you would pay today for Koch's stock? What dividend yield and capital gain rate would you expect at this price? So the solution plan is we would use equation 7.1 to solve for the beginning price we would pay now, given our expectations about dividends, which is equal to $2.31, and the future price is $82.75. And the return we need to expect to earn to be willing to invest, which is 0.089. We can then use equation 7.2 to calculate the dividend yield and capital gain. And that is the formula below. To execute, you have the PO equal dividend plus P1 over 1 plus R E equal $2.31 plus $82.75 over 1.089, which will give you $78.11. So when you use equation 7.2, you see that the company Cox dividend yield is equal to 2.96%, and the expected capital gain is $82.75 minus $78.11 equal $4.64 per share, for a capital gain rate of 5.94%. At a price of $78.11, Cox's expected total return is 2.96% plus 5.94% equal 8.90%, which is equal to its equity cost of capital, which is the return being paid by investments with equivalent risk to Cox. This amount is the most we would be willing to pay for Cox stock. If we paid more, our expected return would be less than 8.9%, and we would rather invest elsewhere. Here we have a concept check. If you own $19,000 shares of stock of Nike and it pays a dividend of 0.29 cents per share, then what is the total dividend you will receive? So the total dividend that you will receive is $5,510. Now, how do you get that? Dividend is equal to dividend per share times the number of shares. So you have the 29 cents times the 19,000 shares of stock, which will give you $5,510. And we will stop there.